So in this video, we are going to discuss the earlier new ratios that we had talked about in the previous section and try and calculate them for our company under question, which is Eicher Motors. Note that we have already put in data for one more year here. And now we can essentially try and calculate the CAGR for these numbers and then add the additional ratios that we had seen earlier, specifically DuPont analysis on return on equity and the ratios on cost to sales data. So those are the points that we are going to add to this now, in addition to our discussion on CAGR. If you recall, the broad formula for CAGR was the final value divided by the initial value raised to the power 1 by n, where n is the number of years minus 1. How many years do we have? That's 1 and that's 2. So n in this case is 2. This is the final value, that's here. This is the initial value, that's here. We can calculate CAGR in this particular column here, right? So let's quickly do that and try and get the data. So open bracket, final value divided by initial value. That's the first part of the equation. Raised to the power 1 by 2. That's because we have 2 years here. Minus 1. And this is calculated in the numbers scenario. So we will have to convert it to percentages and add a decimal point here. So about 15% CAGR in sales is what this company has seen. Sales have grown about 15% each of the years in the last couple of years. Annualized, that's the growth rate. Individual years growth rate could be different, but annualized growth rate is 15.6%, right? So that's the calculation here. If I drag it down, I essentially get the growth rates of other data points as well, wherein excise duty has not really grown significantly. Net revenue from operations has gone up by 16.9%, and other income has actually fallen down, right? I will copy and paste this here as a formula and add this. So that's the growth rate in total revenue. That's other income plus net revenue from operations. That's the growth rate that we find based on CAGR. I can again copy this and paste it here in the cost segment. We find that costs growth is slower than sales growth. Logically speaking, cost of material growth being slower than the sales growth would mean that on a gross margin or operating margin level, there should be an increase, right? That is what we have seen in our ratios as well. So what we'll also do is we'll select this entire set of ratios and just drag it on the left side. So we copy it and calculate it for the previous year as well. Now we are seeing that operating profit margin has gone up from 8.6% to 12.8%. That would mean that essentially sales have grown at a faster rate than costs. That is what we are seeing here, right? I drag it down to get the data for all the years, and we find that costs have grown, employee expenses have grown faster, so have other expenses which have grown faster. Probably there's a trend of extra spend on marketing, etc., that is happening by this company, which is causing these numbers to kind of grow faster. Total operational expense, however, grows slower. Total operating expense grows slower than sales, right? And that's why the margins basically jump up, right? That is precisely why the margins would jump up. So just to keep the formatting intact, I'm going to put this, and there we see that there is a significant uptick in the operating profitability. Why is that so? Is because there is a large chunk of costs that are written off. Earlier on 6,500 crore of revenue, they were making 550 crore of profit. Now you see that on 8,800 crore of revenue, they are making about twice that profit, right? So with a jump of only about 16% per annum in revenues, profitability has jumped dramatically fast. That's one of the primary premises of how companies could do remarkably well if costs go down a little bit, or if selling price increases a little bit, right? Because there is a sort of a disproportionate increase, right? It's like saying My sales are 100 and my costs are 80, which gives me a profit of 20. Now next year, if my sales go up to 110, my costs remain 80, my profit is 30, right? Sales have increased by 10%, but because costs are a large chunk, profits have actually increased from 20 to 30, which is a 50% jump, right? Profits have become 1.5 times, right? That's exactly what we are witnessing here for this particular company, that while sales have gone up slightly higher than the operating expenses, there is a big uptick in EBITDA purely because costs form a large chunk of the sales, right? So the profit is actually a small number which grows at a much bigger clip there. Let's quickly copy and paste the rest of the stuff. So we copy this. Depreciation has gone up dramatically. That should mean they have added capex. Logically, that is the scene. I'm just copying and pasting the numbers based on the formatting. So since all of these are kind of formatted in the green, I'm just copying all of them. We also note that subsequent measures of profit have not grown as fast as operating profit. That's possibly because depreciation growth rate is significantly high. Interest, while is a very small number, that growth rate is high, and so is the case with taxation growth rate as well. So while the company is making profits on an operating level growing significantly faster than what sales is, the net profit eventually goes back to growing at around 20-21%. And that's happening because the other costs, which are below the operating profit level, are not growing as fast, right? So that's the CAGR analysis in terms of how the company has grown. Gives us a couple of ideas that costs are not keeping pace with sales, but at the same time there seems to have been some capital expenditure. That should also be evident in our asset scenario. So if you look at tangible assets here, there is a significant jump in tangible assets, right? So 1496 total fixed assets has almost gone up by 100% to become 2727, right? We can also calculate the same ratios on the balance sheet. Now in balance sheet, obviously, all of it is not really too relevant. So what we're going to do is only the major headers is what we are going to calculate the CAGR on, right? So that's the CAGR on non-current liabilities, current liabilities, total liabilities. That's the CAGR on fixed assets. Look at that, 35% CAGR, and current assets is a 7% CAGR, leading to a 19.7% CAGR. So CAGR on both assets and liabilities total is going to be the same, but we had seen the depreciation numbers growing faster, and that had led us to believe that there is some capex. This proves the capital expenditure. The company has increased its capacity, right? So this proves the capital expenditure because the company has increased capacity, right? So that's what we are looking at. Essentially, that's the important part that we have seen from the CAGR analysis. Let's move ahead and turn our attention to the next part, which is we're going to look at the ratios, specifically return on equity, and we're going to do what is called as the DuPont analysis, right? So we're going to paste it here. Let's put it as DuPont analysis. And remember, what was DuPont analysis? We were saying we have to calculate net profit margin, we have to calculate asset turnover ratio, and we have to calculate gearing or leverage factor, right? Now, net profit margin, we already know the formula is net profit by sales. Asset turnover ratio is sales by total assets. In fact, these two numbers we've already calculated. So I'm just going to link net profit margin to the net profit number here. I'm going to link sales by total assets to the sales by total assets number here. And we're going to look at this, which is total assets divided by the equity component, right? That's what we're going to do here. So we look at total assets number on the balance sheet, that's here for the first year, and we divide it by the total equity number, that is here, right? So we get another set of data. Let's reformat this. Let's drag all of these on the right side. Let's try and calculate return on equity using DuPont formula, right? And that DuPont formula will be a multiplication of these three. So that's product of these three numbers, right? That's, if you remember what we had calculated, product of these three numbers. Convert this to percentages, drag it on the right side. Let's add a decimal point as well. Let's look at the numbers. We get 27, 25, 27.9%. Now this may be different is because we have used net profit by sales here, whereas in return on equity that we had calculated earlier, we had used net profit after minority interest, right? So there is going to be a discrepancy here. So we can't link it directly. We will calculate net profit using the same definition. I'm going to calculate net profit after minority interest. That's 325 and divided by the revenue from operations, net revenue from operations. Drag it ahead and we see the return on equity numbers become 18.5%, 19.2%, 24.5% based on DuPont formula. Let's see what is the return on equity numbers we had calculated earlier. They're exactly the same as 18.5%, 19.2% and 24.5% using the DuPont analysis, right? Now, let's try and decode the DuPont analysis as we go along. So return on equity is jumping, but why is it actually jumping? This part shows profitability. This part here shows efficiency, right? And this part here will show what is the leverage or capital structure of the firm, right? Now we note that in the leverage, there is no change. Efficiency, there is a slight decline. Profitability, there is a jump. And so because there is a jump in profitability, this increase in return on equity is healthy and is primarily driven by the profitability component. Primarily driven by the profitability component and not necessarily by the efficiency. Efficiency has gone down just a tad bit, right? So profitability drives the return ratios in this case, returns in this case. And that's good. That is considered good because these two factors going up were good. This was what we had to evaluate, and that's absolutely consistent during the 2 years. There is no change in the total assets by equity number or the capital structure of the firm, so to say. The liabilities of the company have not really moved faster, and hence the jump on return on equity as per DuPont analysis gives us a slightly better understanding on where is this return on equity move coming from, right? Let's continue and also calculate our costs as percentage of sales to figure out which is the highest cost as percentage of sales, right? What are the major costs that we are looking at? We have cost of materials. In fact, we'll start with excise duty, right? So that's the first one that we're going to plug in. Excise duty as a percentage of gross sales. Rest everything I will take as percentage of net sales because excise duty is gone, right? So we'll just plug in all these numbers, just copy all this and let's just paste all this here. We'll paste it in a simple values format. So we get all the data and we can wrap text here and we're going to put in as percentage of net sales here and we're going to copy this and paste all of it here, right? Let's find excise duty as percentage of gross sales. So that's 605 divided by 6995 and that gives us the percentage data. Everything else is a percentage of net sales. So P&L cost of material divided by my net revenue from operations, right? Now note that I want to drag this down. That's in percentage terms. But if I drag this down, it will give me an incorrect estimate because here I am dividing by P&L B8. Here I am dividing by P&L B9. So I want to freeze the row of the sales. When I'm dividing, I want to freeze the row. But when I drag it on the right side, I also want it to change to C. So I don't want to freeze the column. So in this equation, I'm going to press F4 twice. So I've frozen the row of sales, right? You see the dollar in front of 8. So that's frozen the row, but I've not frozen the column. We've learned this already in Excel. I do that and I just drag it down. And we find all the costs as percentages of net sales, and that gives us an idea that which are the highest costs that the company has to take care of, right? So cost of material is the biggest cost. I can now just take it and simply drag it on the right side, and it will give me the data points for all the years. Remember, you see cost of materials has gone down each of the years. Some of the other costs have gone up, so they've probably spent more on marketing. Employee benefits have remained fairly stable. Raw material costs are highest costs component, and they are going down as percentage of sales, right? So if you think about it, what is essentially happening is that if earlier the sales were 100 and now the sales become 120, if costs were 50, logically costs should have gone to 60, but they've only gone to 55. So as a proportion, cost here was, let's say, 50%. As a proportion, this will be less than 50%. 50% would have been 60, right? 120 is 50% is 60. That's gone lesser. So now this is less than 50%. So cost of material as a proportion of sales is going down, and that's increasing the profitability. Some of the other costs are going up. So this is going up, right? Possibly because they are increasing more on advertising and marketing. And we need to be able to break up all these other expenses and check what these other expenses are. But it at least gives us an idea that for a company like Eicher Motors, which is into the auto segment, both two-wheelers and commercial vehicles, right? For these kind of companies, at least at least half of your sales will go in terms of raw material costs. That's a big chunk of raw material cost that comes in, right? So if you are selling something worth 100, at least half of that cost for any auto company will be a percentage of raw material costs coming in. That's an important understanding for us. That may not be true for some other segments. That may not be true when we look at other examples for some other segments as to how that works, right? So that's the broad calculations that we had to put in and bring in all these numbers. We have already calculated some of the other data points, and our discussion on the interest coverage ratio was also kind of already done. Any number greater than 10 is extremely good. We don't even need to consider this. If this was less than 3, then we would have had a discussion point. Here there is no problem around it. We've already done DuPont analysis here, and we have calculated the CAGRs of each of the items on the P&L to find out what is the growth rate of numbers and how are they really deriving all this growth in profitability, right? That's the final calculation on ratios. We'll now go ahead in our next section and try and compare this with another company. Compare this entire set with another company and probably put on some notes on that entire discussion as to what each company is doing, and discuss the caveats and discuss the calculations and understand the source of competitive advantage that one company might be getting over the other. All that in the next section. We finish this video here.